Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, and Steve Sosnick, Chief Strategist at Interactive Brokers. They join me to discuss if there are cracks starting to show in the macro environment and if investors are looking beyond the obvious and expected earnings beats. Both Steves, it's great to see you. As always, welcome back to Trade Talks. And Steve Wyett, let's get into this. When we think about the macro environment, do you think we're starting to see some cracks here, and where particularly are you seeing them?
Yeah, I think so, Jill. And it's it's important to realize that doesn't mean we're declining rapidly, but we had the first miss on non-farm payroll in something like 6 or 7 months in the last payroll report. We've started to see the JOLTS data indicate that if you just take the mosaic of the job market, it's looking a lot more balanced than it has. But it's pretty clear that high interest rates are having an impact on lower income consumers. If you look across some of the indicators on delinquencies on auto loans and credit cards, it's almost like there's a bifurcated market out there. But Jill, higher rates are starting to have an impact. And so the importance of the labor market, of course, is that's where the Fed's really thinking about, when they're going to be able to start recalibrating monetary policy. And so it really sets the table for inflation, which we get a lot of that data this week. It's going to be really important as we think about when the Fed is going to be able to start recalibrating monetary policy. The economy's starting to say, yes, we need inflation to follow along so they can follow through on that.
Yeah. And Steve Sosnick, the Fed, they don't appear to be that immediately accommodative, certainly not becoming more restrictive, but there really are no near-term cuts based on the data that they're getting unless we start to see some of these start to come down a bit.
Yes, but bear in mind that the Fed announced that they're going to be shrinking the amount of quantitative tightening from 60 billion a month to 25 billion a month on the Treasury side. What that means is that they will be reinvesting 25 billion more when Treasuries mature than they had been doing before. I'm going to argue that they're actually going to do a little bit of what we call interest yield curve control. It's a Japanese term, really, because what they're going to be able to do is have $25 billion more to deploy on the parts of the yield curve that they wanted to. Obviously, it's going to be biased towards short term because that's what tends to mature the fastest. But remember also, we still have an inverted yield curve, which plays into the economic sentiment. And so I do think some of that money that will be used to sort of keep interest rates at the short term a little bit better managed than they were before. So I'm not going to say that they've gone accommodative, but they're certainly going to go less restrictive than they had been.
Yeah. Well, it's interesting. Steve Wyett had mentioned that higher interest rates, the impact of higher interest rates for longer are starting to impact. And we're seeing on the corporate side as well, where there was a lot of variation between quality earnings and ones that just were poorly managed, right? Steve, think about balance sheet structure. It's really important in environments like this.
Yeah, I think that's just, again, it's just coming to fruition as you move through time. If there's a cost to capital, how you've structured your balance sheet, those companies that took advantage of low interest rates and termed out their debt for a long period of time, they're in a great position right now. From higher rates, if anything, are almost additive to their income because now they're earning a higher rate on their short-term cash than even they're paying on some of their longer-term debt. So this is the other reason we think, look, large caps continues to outperform small caps. Small cap stocks tend to be a little bit more subject to bank rate financing, private credit, floating rate debt, as opposed to the big companies that can access the capital markets and really have a little better opportunity to structure their balance sheet in ways that small cap companies. So it's almost like if you look at small caps, it's a rate bet. If the more we think that the Fed's getting ready to be able to lower interest rates, then you start to see small cap stocks perform. But if that gets pushed out further, then small caps really underperform their large cap brethren just because of the increased interest expense and that impact on their income statements.
Yeah. Well, Steve Sosnick, here's a question to you. It might be a bit flippant, but outside of the Mag 7, do earnings even really matter anymore?
Earnings always matter. Posted EPS, I'm not quite so sure these days. The earnings are the lifeblood for any investor. So let me not be dismissive about that. I mean, every company, every investor needs to be concerned with, is their company making money? Are they getting it on the top line? Are they converting that to earnings per share? And crucially important, are they turning that into positive cash flow? If the answers to all three are yes, well, that's a good sign. The problem I have now is earnings per share, the posted EPS, is becoming less relevant to how a company performs after earnings. When you have a situation where roughly 80% of the major companies beat their published estimates, what value is that? What is the point of what is the point of an average when everybody's above average? And so what we're starting to see now is that a lot of companies are reporting EPS beats, but then the stock's going down anyway because investors are rightfully focusing on other factors, whether it's revenues, whether it's guidance, et cetera. And so that's why I'm becoming a bit more skeptical about EPS. I'm starting to think that management has gotten not only very good at managing the bottom line, but also managing their analysts. And I do think that you might get a bit of a reckoning. I've seen some reports that analysts are raising estimates for the coming quarter, despite the fact that guidance really hasn't gone up. Well, the only logical reason for that was that they don't want to miss quite so much again. But if that's the case, then you've raised the bar. And so that could set us up for a tricky next earnings cycle. But we'll worry about that in 2 to 3 months, I guess.
Yeah. Well, Steve Wyett, what about buybacks? We've seen record number of buybacks as well. Does that, skew any of the numbers at all?
Oh, yeah, I'm sure it does. I mean, look, this kind of plays into the ongoing, Steve would point out. We've had net equity declines, issuance, number of companies, shares outstanding for some period of time. And we just, and so this kind of gets to Steve's points, which, by the way, I think historically, Steve, the percentage of companies that beat their earnings estimates is like 70%. So the 80% is more than what it normally is, but we go into every earnings season and it seems like companies have, they manage down the expectations to be able to beat them, which
Exactly.
Honestly, this is where and with valuations where they are, our sense is really that's why the outlook is so important. We're priced. Stocks aren't egregiously expensive, but there's not a lot of room for error in there as well. So if you have a company that raises a question about future revenue or margins or something of that nature, that can have a bit of an outsized impact on the price of the stock today. But companies just announced these gigantic share buybacks. And on one hand, you go, okay, if I'm already a shareholder, that's fine. That's returning capital to me. It increases the share price. But doesn't it call into question the idea of the company having something better to do with their money than just buy their stock back to reinvest in their business on future areas of growth? So there's positive aspects to it. And then there's the longer term idea of, wow, wouldn't it be better if they took that money and actually did something that grew the share value because their business got better?
If I may, Jill, that's why it's been my thesis that Apple, with the giant buyback, more or less acknowledged that they're a value stock now, not a growth stock. If you look at Apple is a phenomenal company. Let me just stipulate that. And I spend plenty of money in the Apple ecosystem each month. But in many ways, it's the best utility out there. Their earnings per share, they beat the 4 quarters ago number by 1 penny, only by beating the consensus estimate, which actually was for a decline, and revenue sequentially declined year over year. So if you have a growth stock that's not actually growing, to Steve's point, why not do something else with this cash? Apple is a cash generating machine. And so I think this is their way of saying, hey, we're a value stock. We may be the best value stock on the board, which means that they're priced aggressively compared to the value stock universe. But this is, I think, a new way of thinking. And if I saw Nvidia doing something like that, which has immense capital needs for their AI business, I'd be concerned. In the case of Apple, I think it's more of an acknowledgement of, what, we're a mature company. We generate cash, and we generate more cash, honestly, than we really know what to do with right now. High quality problem, good one for shareholders. Might want to see more come back in dividends. But that's, I do think, a part of the rationale.
Yeah.
And
I
by the
guess
way, and
I'm sorry, go ahead, Steve.
yeah, I'm sorry, Jill, but and by the way, Steve, Apple's one of those companies with how many hundreds of billions of dollars sitting on their balance sheet that are now earning 5% plus, that this is having a material impact on their earnings per share as they, as rates have moved up too. So I guess ultimately the point is, as Steve's pointing out, you don't get the growth stock multiples if you're a value company. And so Apple can be a fantastic company, but that may or may not mean that its stock at its current valuation is a fantastic investment.
Yeah. Well, Steve Wyett, stay with me for a moment here. Let's spend the back half of this as it relates to the consumer, and housing being one of the biggest concerns that consumers have out there. And there's just no supply. That's the issue. I feel like that is even more important than bringing rates down. There's just nothing to buy.
Yeah, look, there's demand for housing that's exceeding supply, and getting new supply out there is very difficult. To begin with, existing homes, which are about 6 times the size of the new housing market, something like 90% of all mortgages are at rates below the existing. It may be up to 95% now that the mortgage rate's at 7.25. So for people, I'll put myself in this camp. My wife and I refinanced our mortgage during the pandemic. I've got too much house. It's not for sale because my monthly housing expense is less than if we went to look to downsize that. The other part of this that's really difficult, the cost to construct remains high. Yes, we've seen lumber prices roll over and some of the commodities have eased a little bit, but labor costs, land costs are still high. And then you get into the local markets where real estate lives, and you've got all these rules and regulations and the ability to get new projects done. Where I was recently in Phoenix, a growing market out there. They've got some serious housing issues. We've all heard of NIMBYs, the not in my backyard, where you have people show up that say that are complaining about a new project because of traffic or whatever it is that they have. In Phoenix, they now have, Jill, what they call bananas. And that stands for build absolutely nothing anywhere near anybody. That scenario is going to make it very difficult to have any improvement in the supply side of housing, which is the issue, as you point out. And as long as we would say, look, rates aren't going back to that 3 or 4%, or better put, I hope they don't, because that would be a really bad economic outcome. So the idea of supply picking up from the existing homeowner, it probably will to some degree, but not enough to materially shift the supply demand imbalance. And particularly if rates do come down, you're going to bring more new entrants into the housing market that probably that demand will overwhelm whatever increase in supply we see.
Right.
That's a tough nut.
It is. And it's Steve Sosnick, to Steve Wyatt's points. If you were to get rates anywhere near where they were at the 2020, 2021, early 2021 low, there's a big problem, because that's a lot of rate cuts that need to go into the system. But I also feel like throwing money at the issue, some of the proposals that are out there, that's counterintuitive as well when you're thinking about inflation, and that's the biggest issue for consumers.
Yeah, but I'm sort of dismissive of some of the proposals, not even necessarily on their merits or not, just because this is the time in the election cycle that you get crazy proposals. We're in an election year, we're a few months away. Everybody is going to be appealing to their bases. And so you're going to get political rhetoric, to make it appear that someone is doing something about this problem, when ultimately it is a fundamental issue. As Steve said, if you have a relatively fixed supply of some sort of goods, and it's very difficult to increase that supply for number one, because of all the stuff he mentioned, but number two, just it takes a fair amount of time to build a building.
Right.
If you have demand exceeding supply, what happens to prices? They remain firm. That's literally why we had the goods inflation that we had during the pandemic. Was there was demand, the supply was constrained and demand was solid. And so I don't want to get in too much deep into the political weeds. I think most of them end up not happening. Most of them end up being used as something to say it, or something to say in an advertisement or a rally or whatever. But it is a problem, and we're going to have to deal with it. On the flip side, just I was at the options conference a couple weeks ago. Missed you there, Jill and Will, by the way. I would have loved to have seen you there, but I did see many of your NASDAQ colleagues. But the crazy part was, I had this question from our Uber driver in Asheville, North Carolina, a guy with hair down past his shoulders, guy with a beard down to here, tie-dye shirt. And as we're getting out, because I rode there with a couple of other people going to the conference, and of course we were talking about options on the way from the airport to the hotel. And he goes, what would you say to someone like me who's in his early 30s, who sees the demographic challenges, on an economy that's always been built on growth, but yet we have a stagnating population, and it's really increasingly difficult to buy a house. I'm like, whoa, number one, this is the best question I've ever gotten from any, from like the random driver. Number two, we just pulled into the driveway. I know it's a long driveway at this hotel, but I can't answer your question now. But these are things that people are going to have to be thinking about, because what do you do if we're sort of predicated on the fact that we don't have enough housing right now, but the population isn't growing much and it's stagnating, and we're built on sort of an ever expanding economy based on some sort of population growth. Wow, that I couldn't even answer. I can't answer his question now on this call, but I really couldn't answer it then. But these are the sort of demographic issues that Steve Wyett brings up in his points. They're important, and it's not clear that we're really addressing them.
Mm-hmm. Yeah, well, I mean, and that's a great question that he asked. I was blown away by that as well. But you think about it, inflation, let's just call it 0% year over year, right? But when you think about when we had our last election, there, we look at insurance as an example. Prices are up anywhere from 20 to 22 to 25%, right? So if you're a voter, if you're a consumer, that is your benchmark. You don't care what happened year over year. It's still, dramatically more expensive to live these days versus when it was when you were voting in 2020. And I feel like policymakers need to put that front and center. Again, we're Trade Talks on MSNBC, but I think these are things that the Fed and economists and, folks such as us that are talking to the public need to keep front and center, right, Steve Wyett?
One thing that's very important to keep in mind is if inflation is the second derivative. Sorry to throw calculus in here, but inflation is the rate that prices are going up, and the change in inflation is the change in the rate of change. So what it means is, unless that number turns negative, your prices aren't coming down. You'll notice I don't have a backdrop. I went to go get a backdrop for this room, and I priced out, with the same place I did it before, and it was probably 50% more than when I priced it out, which was during the height of COVID, and they just needed somebody to buy something from them. And now the price is substantially more. And so as a result, I balked at putting it behind me. But this is the sort of thing is when you look at comparisons, prices are higher, because even if you have a slowing inflation rate, it still means that prices are going up. They're not going down. And you get sticker shock in a lot of parts of the economy, whether it's housing or whether it's the place that makes my backdrops.
Mm-hmm.
Yeah, well, it's a lovely minimalist background though, Steve. So I wouldn't be afraid to stay with that. But I think the idea that you're getting at there, Jill, and what Steve's talking about is, look, it's aggregate inflation. That's what we're dealing with. It's the aggregate increase in the prices. And so when we hear, and I'm sensitive to this too as economists, and you hear politicians come out and say, hey, inflation is going down. And the way we look at inflation, that's right. But for general consumers, they're like, what are you playing me for a fool? No, inflation's not going down. I'm still paying more. It's still significantly more expensive, as you mentioned, Jill, to live than it was before. And by the way, when I'm presenting, nothing gets a reaction when I speak about inflation, when I ask them, has anybody renewed their insurance lately? Because that seems to be the real hot button within the numbers. Now, look, insurance is not going to keep going up at that same level. Car prices are easing a little bit, particularly used car prices. We should see some benefit there. Housing's really the biggest issue, Jill. It's a third of CPI. It's a sixth of the PCE. That's really what's going to, that's really the big number as far as inflation. But overall, we know it costs more to live. The grocery store is more expensive. I don't care what you say. It's just our overall, there's a sense that wages have not kept up with this. And that's why I'm saying this is where you're seeing that bifurcation, Jill. Inflation hurts those that can least afford it the worst. And if you're in the bottom half of the income bracket right now, this aggregate inflation that we're dealing with is very painful. And I do think that does have political implications, that has implications for policymakers. that when they talk about inflation getting better, it's almost like they sound a little tone deaf. They're not wrong in the way that they're speaking about it, but they're a little tone deaf when it comes to how it's impacting consumers.
All right, Steve and Steve, appreciate the insight. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.